Hello everyone, EJ here. Are you worried about the future of the housing market? Today, we're diving into a topic that's been on everyone's minds, the housing market. Specifically, we're going to talk about the possibility of a major crash in 2026. Now, I'm not in the business of predicting the future, but there are some concerning signs that we need to address. We've seen record-high home prices, historically low interest rates, and a shortage of inventory that's driving competition through the roof. But what goes up must come down, right? The big question is, when will that happen and how bad will it be? Some experts are pointing to 2026 as a potential tipping point. They cite rising interest rates, the threat of recession, and persistent inflation as factors that could trigger a correction. Now I know what you're thinking, EJ, you're going to scare me into selling my house. That's not my goal here. My goal is to educate you about the potential risks and opportunities in the market so you can make informed decisions about your financial future. Whether you're a homeowner, a potential buyer, or just someone who wants to understand what's going on, this information is for you. So, buckle up because we're about to take a deep dive into the factors that could shape the future of the housing market. We'll look at historical trends, analyze current conditions, and hear from experts on what they think lies ahead. By the end of this, you'll have a better understanding of the forces at play and be better equipped to navigate the ever-changing world of real estate. To understand where the housing market might be headed, it's crucial to look back at where it's been. The housing market is cyclical, meaning it goes through periods of boom and bust. Remember the housing crash of 2008? It was just the latest example of a pattern that's been repeating for centuries. In the years leading up to 2008, we saw many of the same warning signs that are flashing today. Easy credit, low interest rates, and speculation fueled a massive bubble in the housing market. When the bubble burst, the consequences were devastating. Foreclosures soared, banks collapsed, and the global economy plunged into the worst recession since the Great Depression. Throughout history, we've seen similar patterns play out time and time again. The lesson here is clear. History may not repeat itself exactly, but it often rhymes. Now, let's fast forward to the present. The housing market is once again experiencing a period of rapid price growth. In many parts of the country, home values have reached all-time highs, surpassing even their pre-2008 peaks. This surge in prices is being driven by a confluence of factors, creating a perfect storm in the real estate market. One of the primary drivers is the historically low interest rates we've seen in recent years. The Federal Reserve slashed interest rates to near zero in response to the COVID-19 pandemic, making it incredibly cheap to borrow money. This, in turn, has made mortgages more affordable, fueling demand for homes. At the same time, the supply of homes for sale has plummeted to record lows. The pandemic caused disruptions in the construction industry, leading to a slowdown in new home building. Additionally, many homeowners have been hesitant to sell their homes, opting to stay put and take advantage of low interest rates by refinancing their mortgages. This combination of high demand and low supply has created an incredibly competitive market for buyers. Bidding wars have become commonplace, with homes often selling for well above asking price. In some cases, buyers are even waiving contingencies such as inspections and appraisals just to have their offers accepted. While this frenzied activity may seem like a good thing for sellers, it's important to remember that unsustainable price growth can't last forever. As interest rates rise and affordability becomes a bigger concern, the current pace of appreciation is likely to slow. Section 4. The Fed's Balancing Act, Interest Rates, Inflation, and the Threat of Recession. The Federal Reserve, or the Fed, plays a crucial role in the health of the housing market. As the central bank of the United States, the Fed controls monetary policy, which influences interest rates and the overall economy.
Their decisions have a ripple effect on everything from mortgage rates to the stock market. In recent years, the Fed has kept interest rates at historically low levels to stimulate economic growth. This has made it cheaper to borrow money, encouraging spending and investment.
However, this easy money policy has also contributed to rising inflation, which has eroded the purchasing power of consumers. To combat inflation, the Fed has begun raising interest rates.
Higher interest rates make it more expensive to borrow money, which can slow down economic growth. The Fed is trying to engineer a soft landing, where inflation is brought under control without triggering a recession. However, this is a delicate balancing act.
Raising interest rates too quickly could shock the economy and lead to a recession. On the other hand, not raising rates enough could allow inflation to spiral out of control. The Fed's actions have direct implications for the housing market. As interest rates rise, mortgages become more expensive, which can dampen demand for homes. This could lead to a slowdown in price growth, or even a decline in home values. Section 5, the experts weigh in, overvaluation, new construction, and the future of housing. To get a better understanding of where the housing market might be headed, it's helpful to turn to the experts. Economists, real estate analysts, and industry insiders are closely watching the market for signs of what's to come.
One of the biggest concerns among experts is the possibility of overvaluation in the housing market. Home prices have risen so rapidly in recent years that some analysts believe they are no longer supported by underlying economic fundamentals.
Another factor that experts are watching closely is new construction. However, there are signs that new construction is starting to pick up.
Despite the concerns about overvaluation and rising interest rates, many experts remain cautiously optimistic about the long-term outlook for the housing market. Section 6, what it means for you, advice for homeowners and potential buyers. So, what does all of this mean for you? Whether you're a homeowner, a potential buyer, or just someone who's interested in the housing market, it's important to understand the potential risks and opportunities that lie ahead.
If you're a homeowner, it's important to remember that your home is first and foremost a place to live. Don't let the fear of missing out on potential profits drive your decisions. If you're happy in your home and can comfortably afford your mortgage payments, there's no need to panic.
However, if you're considering selling your home in the near future, it's important to be realistic about your expectations. The market is likely to cool off in the coming years, so you may not get the same sky-high price that your neighbor got a few months ago.
For potential buyers, the current market can be incredibly challenging. Competition is fierce, prices are high, and it can be discouraging to keep getting outbid. However, it's important to remember that this too shall pass. The market will eventually cool off, and when it does, there will be opportunities for those who are prepared.
In the meantime, it's crucial to be patient, disciplined, and financially prepared. Don't stretch your budget beyond what you can comfortably afford, and be prepared to walk away from a deal if the price isn't right.
Section 7, the bottom line, preparing for the future of the housing market. The housing market is constantly evolving, and predicting the future is impossible. However, by understanding historical trends, analyzing current conditions, and listening to expert insights, we can make more informed decisions about our financial futures. While the possibility of a housing market crash in 2026 is a topic of much debate, it's important to remember that no one can predict the future with certainty. Instead of focusing on trying to time the market, it's more important to focus on what you can control, your own financial situation and your long-term goals. Whether you're a homeowner, a potential buyer, or simply someone who wants to be more informed about the real estate market, remember these key takeaways. History tends to repeat itself. The housing market is cyclical, and understanding past bubbles and busts can help us prepare for the future. Current conditions are unsustainable. The combination of high prices, low rates, and limited inventory cannot continue indefinitely. The Fed's actions have consequences. Rising interest rates can impact the affordability and demand for homes. Experts are divided. While some are concerned about overvaluation, others remain optimistic about the long-term outlook for housing. Focus on what you can control. Prepare financially, be patient, and make decisions that align with your individual circumstances and goals. The housing market is a complex and ever-changing landscape. By staying informed, being prepared, and making sound financial decisions, you can navigate the ups and downs and achieve your real estate goals.